So thanks so much for joining us. Welcome, everybody. We've got a really exciting panel here who basically cover the whole ecosystem, everything that you might want to know, expect about FX and infrastructure and settlement and you name it, they know about it. So to introduce the panel, first we've got Simon from LMAX, who's bringing, I would say, like market structure and infrastructure lens. Andrew from oneZero, representing connectivity and technology. Hugh, who's very well known and giving us institutional best practice. Drew from ATFX, he's covering the retail and broker lens. And we also have Martin from Titan FX. And I think Martin has a really fascinating perspective on emerging markets. So let's dive in. In the prep call that we had a fascinating conversation actually around a kind of retail institutional reconvergence. And I wanted to come to Drew first because he made some really interesting points around the changes in the market, particularly around brokers.
I think that, you know, what's interesting, I've been doing this 25 years, that we've had in the last 10 years sort of like a drifting apart of the retail and, uh, and the institutional landscape. As retail brokers actually hedge less, there's more internalization, there's more B-book. As the market moved more towards like emerging market clients, there's kind of been more of a divergence from retail away from the institutional. But then at the same time, on a totally parallel track, as people are going more multi-asset, as you get true multi-asset, you are starting to get to see, okay, there's kind of the reconvergence. So I think there's like in traditional FX CFDs, it's kind of diverging, but in the multi-asset is, converging. And I think what's interesting is that we are, and I've said this in other panels before, we are like on the verge of some pretty significant changes, right, in the industry in terms of new entrants coming in. A lot of this convergence, is going to play a huge role in where clients choose to go, and that's kind of you know, my observation on it.
Excellent. So Simon, I also wanted to come to you on if you're seeing a convergence in execution and standards and what that looks like.
I think
Test, test.
this. Thanks. Thank you. Sorry. So I think first thing on that is I think there's a wide spectrum there through retail to institutional. You've got kind of retail, you have brokers, family offices, the banks, the principal trading firms, the buy side. So it's a big spread there. And if you think about what's the same for them, and largely the access to data and information is now the same. There's no longer a market that people can't see. If you're prepared to pay, you can get that data, you can get that information. And also, like, the liquidity is largely the same as well. That's kind of part of the foundation of LMAX, is providing that wholesale institutional liquidity to our broker partners for the retail clients. And then if you think about what's different though amongst those, some of the spreads are different. And actually now in retail, the spreads are often tighter than available in the institutional market. And so that's like a big change from maybe sort of 10 years ago. And the other bit that's different is really the kind of demands on your technology and your procedures are very different once you start moving along that spectrum into institutional. So I think that it really depends where on that spectrum you're targeting as everyone looks to expand and grow.
I think if I could chime in, I think it though I agree that there is a constant convergence and trickle down of sophistication happening in this market, I don't think it's a new trend. I think it's a future trend. I think it's a perpetual trend that we're going to see in the market as market dynamics evolve. And like the best evidence I can give you of that trend being real and ongoing is my continued presence here. We started the company to bring institutional enterprise grade technology into this market and have continued to do so. And I think the trend that we're observing and the cyclical, you said reemergence or shift, also comes from looking at this OTC market as a zero-sum game of supply and demand. as internalization needing to happen at some point without the central limit order book or exchange aspect that you see in other markets, and a shift in balance sheet dynamics. Banks over the last 10 years have had less balance sheet to allocate to internalization. In retail, there has been more flexibility as we've grown and become more regulated and understand what needs to sit behind a large internalized position. And within our client base, what we're seeing is adoption of technology that was typically used in market making and institutional, and a majority of our clients using things like SKU and creating their own pricing and liquidity as a result of being this source of internalization and true liquidity in the market to their customers.
Hugh, I also wanted to come to you on retail expectations and if they're misaligned, do you think, with institutional liquidity?
Absolutely, they're certainly improving. There's been cycles in this debate, and Andrew mentioned his survival instincts have allowed him to stay the course and come back again and move into the institutional space. And we were just talking about that while we were waiting for Drew. And so there is definitely an expectation gap out there, primarily around, the regulatory or operationalization efficiencies and the investment needed to scale up to the institutional level. And then if you take that to, extend that beyond to liquidity, and as already mentioned by Simon, top of book is the expectations in retail to having top of book liquidity. When you move to institutional, you need a much deeper liquidity paradigm. And the expectations there around low latency, around rejects, co-location, you have to be multi-regional. And so these are significant factors that you have to take into account if you really want to make a significant move into institutional from a retail presence.
Another topic that came up in our prep call was around what good execution means in 2025 and how that expectation or definition is shifting. And it would be great, Martin, to go to you on how your emerging market clients, their expectations are shifting and what they define as good execution.
Yeah, good execution, low spread, low latency, no requote. All that is first marketing. Yeah? We have to acknowledge that we are, as a retail broker, we're all fighting for attention, to give the client a reason to come to us. I don't think the client can make a fully conscious choice of one broker compared to the other one, saying I'm taking that one because execution is so much better. That will be used or said a lot of time, but is it true? How do you measure that actually execution? If the spread are really, really tiny and tight, there's a good chance that you might not get the execution actually that you deserve. If the spread is maybe a bit wider, you will get probably more chance to be actually filled. Your order will be filled at the price that was advertised to you initially. So that's my message to the trader that are maybe listening to that. You have to be conscious of how much there is like an image and how much like underneath there is the reality, and you have to fight to get to that reality because you don't necessarily have full transparency. So I would say that in emerging market, what is the a good execution or what the client asks is probably transparency. He's asking actually to get what is quoted, what he sees. And it's a battle from our side. It's a battle to show that we are the most honest, transparent, and decent broker on the place, so that we want actually the clients to be a winner, because we believe that if the clients win, we all win somehow. Anyway, sure that if you play long time, you might also lose.
And Hugh, I think it would be great to understand from you as well, if you can talk through some of the changes that we've seen in Asia, particularly the regulatory shifts, and how they reset the standards and expectations across the board.
Yeah, well, look, we talk about MiFID on this side of the world, but Asia is quickly catching up. And I don't know if a lot of people have been following what's happening in Korea. They're really opening up their market. They made that decision many years ago, but it's now coming to the fore. Um, Foreign institutions are now able to interact with local institutions via RFI, which is a new legislation. With that, though, comes quite significant investment in the local community. You have to tie up with a broker. You have to engage in quite transparent reporting with the central bank. And so what you are seeing there is that markets are opening up, but at a cost. And there lies the challenge of moving from retail to institutional. There are significant investments which aren't technological. They're not necessarily liquidity, but they are multi-year investments in local markets, regulators, and that requires also boots on the ground, um, investments in property, etc. So it's not something for everybody. Certainly in my organization, SGX Group, we're looking at it, but my previous organization shied away from it because it does distract management. It distracts you from your primary objectives in your core markets. But it is a pathway to the future, and Asia is growing, and it's an area of significant opportunity that we all know, whether it's Korean won or Taiwan. India itself is another market that's significantly opening up, and again, following the same pathway. Singapore has led the way with the MAS, and they've set the playbook for most of the other nations that are looking to grow and develop.
Another thing that we discussed was this idea of the competitive landscape in general and blind spots. So everybody spoke briefly about this on the panel. And so I'd love to know from each of you what you think the blind spots in the market are right now. Is there anything, Drew, if we come to you first, anything to do with, what brokers might fear from exchanges, neobanks?
Yeah, I think that if you look at it, it kind of ties to execution and other things. As long as the industry is focused on this pocket of gambling, leverage traders, right? Then really, execution is a secondary element. Onboarding, experience matters more because essentially most people, like we said about spreads, are giving unrealistic trading conditions, not just spreads, fills, all of that stuff, right? Because if the client's overall going to lose money, then, who cares what the actual market's doing, right? And I think the landscape is going to shift, right? As you get, like, we are in our little world, right? And as the big guys come in from the crypto business, from the Robin Hoods of the world come into this business with tens of millions of accounts and, insane amount of budgets, right, to do their stuff. This is going to be a sub portfolio element of it, and I think they going to make the standards very different, right? And I think there's always going to be a niche, in this business, but I think the landscape is going to shift to there's a lot of like big super apps is kind of a trivializing word, right? Is you have to think about what if Binance owned IC Markets or Pepperstone or something like that, right? Or one of those brokers, right? Top 10, top 20 broker. How big would that broker be, right? How dominant, right, would that broker be? And I think that is something that is going to happen, right? I firmly believe. I looked, and I talked to some of the big players. Like, is it tomorrow's agenda? No, but for a lot of people, I was involved in a sale like Ninja Trader sold to Kraken, and this is primarily a futures business, but that is a hair away from our business, right? And I think that's kind of where the big changes are coming. Like the big supermarkets are coming here.
I could tell you from experience with those three names that if that happened, Binance would finally get access to some real technology to run their business as well too. So I welcome that change. But jokes aside, there, I don't think it's fair at this point to say that expectations and spreads and what happens in the retail market is unrealistic because it's here and it is what it is. Now, it's a conundrum because you'd think as you move further away from the sophistication and the wallets that exist in institutional down to retail, common principle would be that spreads get wider. It's not the case in this industry. And it's a reality. It's like saying, oh, somebody who goes to a casino where they give out free drinks has unrealistic expectations because drinks should cost money. They don't because of how that market works. And so I think the blind spots all come down to risk. It comes down to spreads are never going to get inverted. So there's a zero-sum game happening there. How are brokers managing the risk and input and new liquidity that's coming in from a growing base of speculative retail traders who are generationally receiving more wealth transfer, who are more interested in trading? And how are you taking some of these large positions and making sure you're remaining hedged in the market? Because what the worst thing that can happen in this space is a blow up of a book, a blow up of a position, an insolvency of a broker that takes us steps back in terms of how we've evolved as an industry. We used to see this on a daily basis in the US back before CFTC and NFA regulation. There was 400 brokers there and they disappear and start back up. We can't go in that direction. And those blind spots I think we need to fill by that continued perpetual convergence of institutional sophistication. I don't think retail hedges enough with not even multi-asset, FX derivatives, use of options or NDFs or forwards or things that we see in an exposure to institutional franchise and a lot of experience in retail, where retail is still predominantly, when they do hedge, doing so by crossing the spread in a spot asset. And that's where we're investing in this market, and our investments in the institutional space are feeding back into our ability to help manage these large, sizable, bank-sized positions that exist at retail brokers.
I think that I agree with you. There's some really big changes coming. I think the players in the space are going to change. If you look at, like, Robinhood already has half the number of clients that Schwab has, active clients Schwab has, who've been around for decades. So I think that's changing. But I think the other bit is kind of accessibility of products. Like tokenization has already started. It's coming. It's going to make the range of products available far wider than it is now. And people are going to start trading things they're interested in rather than just products they can change. We're already seeing, and from our broker partners now, we're seeing, like, in the last month, gold was more popular than FX. That the range of products is changing massively. And I think the other things that is changing is the reasons that people are starting to trade, like the way where they look for influence is changed as well. If you look at, like, the news, the BBC is still the biggest source of news in this country, but people aren't watching it on TV where you're told what's interesting. They're looking at it online. They're deciding what's interesting for them. So they're going to decide which products they want to trade. And people are going to have to move much faster on product delivery to retail clients.
Couldn't agree more. I think a very interesting point that actually bypasses one of the premises that we're going to be more like equity exchange driven regulated markets, because I actually think retail's in a position with the convergence with the crypto space, multi-asset retail, to just hopscotch right over exchange traded products and go into tokenizing assets that look a lot like a CFD but are better structured, more well-funded, and more understood by clients. And that crazy triangulation of bringing in those new asset classes to brokers, using some lessons learned from the crypto space, but also kind of peeking at it and saying they just innovated by inventing perpetual futures. If you squint enough at a perpetual future, it's just a CFD that has been given a prettier name. I think we're going to see a lot more of that, and it's something that will be very good for this space.
I think that's a great segue into the next topic that we wanted to discuss, which is around what brokers will need in 2026. So, Simon, it would be great to get some thoughts on any capability gaps you're seeing where brokers are trying to operate across retail and institutional flows.
Yeah, so as I mentioned on the product space, I think you want to make sure you're digital ready and you can handle digital products. There's definitely going to be, we don't know when that change will come, but going to be a big change. I think the other bit on the institutional side is just that connectivity layer, the kind of technical connectivity is in the implementation of that is very different in institutional to retail. I think obviously the role of a prime broker, how that affects the workflow is very different. And then the last piece I think is around jurisdictions, like being regulated in the right place for institutional flows is going to become increasingly important as well.
And Martin, from an emerging market lens, what do you think about the infrastructure and relationships that will be necessary for, or I guess non-negotiables for brokers in 2026?
Yeah, from my point of view is from the size of broker that I am at Titan FX, and the way we operate, we believe 100% in localization. We believe that we need to focus on a certain clientele, and that clientele, we need to be the best one with their language, with their payment method. We need to be the best one with the product that they care about, having like a loyalty program for them, and investing a lot into the brand, because nowadays the only way to fight the big guys, these super app or these guys, is to still have like a name or brand, or to have a meaning for a certain subset or certain region or certain nation. So you are better equipped to fight the big one, the Coca-Cola, that has like that brand worldwide, that try to localize, but it's still like seen as the imperialistic guy. So if you can be something for someone and care about that, I think you do have a shot. The blind spot for me, as I'm switching back to that, one of the blind spot that there is, I think it's so trendy to talk about AI, but there's one blind spot where, if you imagine like sci-fi a bit AI to a certain extent, that like all of us here could actually eventually start a brokerage firm quite easily. I think we can say legislation or regulation is important, but is it like um, are we going to break out from it eventually? And if we break out from these regulation and this legislation, and coming from emerging market where the legislation are much lower, we could imagine like that it's quite easy to have an AI that actually do your website. You have your front end for your trading platform. You plug your stuff directly, and you are a small brokerage firm. Like for the barrier to entry could be really low eventually, and that's one of the blind spot. The other blind spot to me, it's emerging market also angle. It's we see that there's more and more coordinated attack, I would say, from the client side, that actually will try to abuse, let's say, the rule of the trading, and they kind of understand better and better how actually the risk team is operating. And I think it's something that we don't talk about it, because we don't want them to know that there might be like some tricks to actually cheat. But if you have a higher percentage of your clientele that is actually trying trick to cheat and coordinate with like AI and new tool, it might be and at the same time, broker are more be booked, they are reducing their spread, they have a smaller balance sheet, and then we go into the scenario of Andrew, where you have one that collapse, and then the reputation, and then you kill the whole industry.
I think your point there and Simon's point earlier about Robinhood brings us right to where this market needs to be thinking looking into the next year. For almost 2 decades now that we've been operating in this space, it's been very difficult for retail brokers operating in FX and OTC markets to develop a brand identity, because we all operate through very similar platforms with very similar trading conditions. And where oneZero has put a significant amount of investment, and so I have some bias, is in equipping brokers to use AI, deliver experiences to their customers that are unique and differentiated for regional markets, to bring an experience to clients. Because we've been sitting here for 2 decades saying, well, IBs and traders like EAs, therefore that's the way we're going to access them. And then over the last 5 years, we've had this manifestation of these new crypto front ends and Robinhood front ends that I opened a Robinhood account, I logged in, I couldn't even find a bid and ask. It was just buy to the moon. And those experiences that clients are clearly seeking, so much so that they invented a new asset class to go and trade on the weekends and bring that experience to them is where we need to go as an industry. And so we're investing heavily in being able to equip our clients to still rely on scale, low latency backend infrastructure, but create their brand identity and reimagine it with how they engage their clients.
Yeah, I think obviously if we go to blind spot, the number one blind spot everybody knows today is not rocket science, is that we are all long gold, right? And when I say long gold, is that most brokers are 50+% gold exposure and live or die on gold volatility, right? So we're not long gold, but long gold volatility. And I think that as a business, this is like, again, 25 years, we've never had that concentration risk. And the biggest risk in this industry, people have to think like January to August of 2023, there was like a gold volatility drought. And just from my experience, I would say half the industry was probably 4 to 5 months away from bankruptcy, right? And big names. And I think that if you looked at it and said, okay, what's the blind spot? We have that for a year and a half because the clients don't adjust that quickly to like what's new and volatile, not in that segment of time, right? And I think that brokers have to be very conscious that the B book works well and it has a great track record, but it's, there are going to be segments and there are going to be times that the business will have to change, not even permanently, just they have to have transition periods and all these things because there is more brokers go away, not from trading blowups or having the wrong risk, but from not enough volatility, not enough thing, and the overhead being too high, right? And I think that is probably the biggest risk to brokers. And if you look at blind spot today, we have widened spreads and everything that doesn't move to discourage clients to doing that. We have narrowed spreads to the crazy amount, right? And everything that moves to encourage it, right? And that's kind of like a optimization of the B book, right? But we have then now focused it to such a degree that I think it's really risky.
I have good news for you because I sat through the last panel where 6 incredibly intelligent economic analysts could not agree of where they wanted to go long in the world. And I wanted to scream in the back, like, you just want to be long vol right now, which everybody in this room is. So it's a happy answer. And how long will that perpetuate for? We don't know. But it's a good period to be thinking about and growing your business because, as I've said to a lot of people this week, I'm emotionally hedged on either Trump goes back to playing golf and stops tweeting macroeconomic policy by surprise and generating a lot of vol. I'll be happy as a human being there, and I'll be happy as a provider of risk and low latency infrastructure if the world continues as it is right now. So,
But maybe profitability can come not from like booking things, but just offering a broader range of products that people want to trade as well, and therefore less need to hold on to the risk to make money from that.
Yeah, but you can offer as wide the product you want if the client is trading gold. That's
I think the key here is diversification, right? If you're single client segment, single asset class, then you're always going to be at the risk of low volatility. In the institutional space, we had that challenge, back in early 2000s and late 2000s, and we weren't going to go bankrupt, but there was certainly a lot of us sitting around going, "What's next?" Right? And fortunately, there's larger pockets to play, and then also you could diversify into fixed income. And you do see a lot of FX institutional platforms eyeing up alternative assets, multi-assets, moving into fixed income, whether it's credit or bonds. So there might be a lesson there for retail too. I don't know.
I think that on that risk of blow up, like one trend that we don't have an influence on, but I'd love to see that converges with tokenization of assets and use of stable coins is the transparency that would come from that. That I would love to see regulators utilitize this crypto and digital asset space and push towards mandating holding balance sheet in an asset that's easily observable. And then you can prevent the blow up by observing what people are holding in a transparent way, what their position is against their clients, and what they have on their balance sheet in order to cover that. And with those three things, you should be able to prevent a blow up at some level. I think we could move very quickly there. It hasn't happened yet, but it's certainly something that's coming, I think.
I think you could also introduce like diversification to what people are holding as well. Like you don't want to say, okay, you have to deposit dollars with us now. It could be a stable coin, it could be Bitcoin, it could be anything. And as long as you allow some sort of kiosk for conversion of those assets people are depositing with you into what you want to hold, you could create a lot more diversification there and maybe less risk to the industry.
Not if you're a payment provider, but otherwise, I think that there's a lot of yield to unlock for brokers in optimizing that flow as well too, while creating transparency. So that's something we're not involved in that space, but something we'd love to see in the market.
I think that's going to come to payment providers as well, of like, pay for anything with anything. That's coming.
So, question for each of you. If you were to create a brokerage, a brand new broker, or a trading platform right now, what would you do that would be different from 5 or 10 years ago? And I'll go to Andrew first.
I can't answer. I would never start a broker in oneZero as a technology neutral entity. I think what we're equipping brokers that are entering this market and starting fresh with is access to a larger pool and ecosystem of liquidity than we've ever had. Being a neutral provider has been at a core of what we built in our business, and I think has been very beneficial to our client base to have optionality as they grow and approach different markets. I think the other side of the value chain, not where liquidity is coming from, but how we're distributing to our clients, how we're engaging into different markets like the crypto space or building out CRMs. I think the ecosystem that feeds this environment needs to evolve from what we've invested 16 years in building a liquidity ecosystem. I think there needs to be more utility around the entire market, and that's what I'd be looking for as a startup broker is how am I differentiating myself? What clients am I going at? What are they looking for? How am I drawing that speculative attention away from an under-regulated digital assets market into a well-regulated and maturing area of the industry that has the ability to gain value and grow and generate revenue from a speculative client base and do so conscientiously?
Drew, do you have any thoughts? What would you do differently?
Okay, lessons of 25 years. The less regulation, the better for anyone waiting for the government to fix their problems. We don't need to comment on that further, right? Then that would be lesson one, okay? And I think it used to be when I started FXCM in 99, regulation was important because, you needed it for legitimacy. You wouldn't have big deposits. Today, you have lots of offshore guys. If they have a brand, lots of customers, a good internet reputation, they're doing better than the regulator brokers. It's just user, satisfaction, right? Faster withdrawals, faster deposits. Everybody knows that drill. I think the second thing was definitely missing in the market is multiple platforms, multiple asset classes. And I really think that it is where all the invasions or the barbarians are coming for us is with those things. If we don't adopt to that, I think that is going to be the big that and if I was starting from scratch, I would absolutely have one back end, 5 front ends. I would have, when I say multiple asset classes, not different types of CFDs, as in stocks, as in those type of things. I think it's super important in one account, not this like, oh, let's juggle around my money in between different things. That's what I would do.
Does that resonate with you, Martin?
Yeah, I'm not sure I'll have the courage to start from scratch. I would find the market pretty crowded, and there's a lot of players that are offering like a wide range of like small differences. So yeah, but from the position that we are in, I find interesting to. I agree with Drew with the diversification of your product, because you have a clientele, so either you try to find new client elsewhere in new territory or new or a different like segment of the market, or you try to sell a more or a different other choice or other instrument or other product to your same client. And I would choose the second option, to sell more stuff to because of these barbarian that are coming. So adding like crypto, also really positioning probably an offer transparently, saying this is a high leverage, high risk, short-term investment. You're gonna put the money there, you're gonna make great money quickly, or you're gonna lose it. But we also have like a balanced portfolio if you want for your old days, and this is where you should put it. Trying to be as honest, as transparent, as authentic as possible. That's what I would do if I was to start a brokerage firm now.
We just have to be careful when we say bringing in crypto as a new asset class. And this is something where I've had a position on this for multiple years. I think there's utility in tokenized and digital assets. I don't think it's many of the ones that we see today. And so I think on this side of the industry, this is not about we need to get ApeCoin or some manifested zero utility speculative asset that's been born out of nowhere. We have to look at ourselves and say, why did ApeCoin come? What were these traders looking for that we weren't bringing to them? And use some of the lessons learned from that space. Okay, tokenized assets, building tokenized equities. Let's solve the problem we had a couple summers ago when we went into contango and everybody figured out that not all crude oil spot contracts manifested into CFDs are created equal. And you can barely even risk transfer them between brokers, let alone hedge them out to the market. So taking those problems, overlaying some of the good technology and solutions that's come out of digital assets, but like just I don't like to say we need to get crypto in, because then I get 1,000 emails of like, oh, we need the whole tail of Fartcoin and everything you can see on Binance in this industry. We don't need that. We need to ask why that came and solve it with a real utility capital market driven asset that is interesting to retail.
But I think you also have to deliver the products that people want to trade. And I think that we talked about like tokenized assets. I think getting faster at that and being like I don't know if I pronounce this correctly, but there's kind of Shein of fashion for broking. So you're much quicker at saying, this is what people are interested in. I can make that available to them. And then I think adding other services on top of that, you could do. There's no reason you can't offer your clients like a payment service as well, like be wise too, that you have that FX capability. You could do the payments. I think you could offer them now credit cards as well. That you can say, oh, you've got a balance in something, I can give you a credit card against that. So I think all of those extra services that just come along with what you're offering are going to be important.
But it'll take industry consensus. We can't every broker can't go off and now start minting their own versions of assets. We've just recreated a more complicated version of the CFD problem. So I think a lot of it looks back to the major players in the industry to get together and say, what can we do in this space for self-preservation purposes to combat this trend of just being able to make up assets and offer them to clients and tell them that they want it to speculate, and but converge and bring something to market that's actually provides risk transfer utility within our ecosystem, but also the allure that retail traders are looking for and those that drive to crypto are seeking.
Or like competition will drive innovation.
I'm a big fan of just taking copying someone out there already, and there's somebody or an organization that I admire a lot is enormously is Revolut, and you can see what they're at, how they've dot plotted their way through addressing retail banking, but then on the periphery using technology to move into servicing clients, as we talked about. And all of the points raised earlier are absolutely true. What's your USP? What's the best technology? Future proofing it, whether it's digital, blockchain. But it's absolutely sure we'll get new technology coming in and new participants. We probably don't know what the answer is, but there's one out there I can see, Revolut, and they could easily do what Drew mentioned, which is go buy a big broker or a bigger retail, combine it all together, and somehow be global very quickly. I mean, if you look at their numbers, I don't have them off the top of my head, but they're quite substantial, right, in terms of their adoption. And you compare that against retail brokers, they could easily swallow that up tomorrow and have the discipline, have the infrastructure, and the reach to make a significant impact.
Okay, so we've got 2 minutes left. So if anyone is brave in the audience and wants to ask a question, I think we have time. Yes, I can see somebody with their hands up.
Who is it, Victor?
Let's give you the mic.
Drew can answer this.
Here you go.
My question is, which part of the brokerage tech stack is going to be disrupted the most by AI?
The peripherals. In our experience, and I've gone through a complete revolution in my thought process around AI over the last 4 months. It is evolving very rapidly from a toy to a cute thing to something that can now pass. Anthropic's latest model was the first one to ever pass the programming tests that you need to do to write C++ code at oneZero. And that's very sensitive to me because I've never been able to do that since I got kicked out of coding like 12 years ago. It does not write great C++ code yet because AI is driven. It will always produce a result. Every AI model will give you a result no matter what. The quality of that result is based on the data that comes into that model and how it's trained. There is a ton of web interface, Python, and other code examples out there that have trained AI to make amazing things. And in our latest iterations on this, just in the past few months, we've been able to take our backend infrastructure, our REST APIs, and build like core components of brokerage very quickly and pass them to our clients as examples of how they can utilize around our architecture. Building C++ code with it is a little tougher. There isn't as much raw C++ out there that actually drives good coding and good models. So I mean, obviously, I'm really biased. So my answer is AI will do everything except what oneZero sells. But
I would say it's the EAs. So if you look at sort of the dominance of MT5 as like this is where the EA come from, is the simplest thing, kind of like what we were saying, to replicate and what AI can do. And there's already platforms that do it. They say, this is my idea, or this is code from a different system. Translate that into what this system does. And then this system may be faster, then there's the back end is better. Where do I get? So this is why sort of my whole thing about multiple platforms is because we can replicate the ecosystem of EA super quick, right? Where do I get the best real execution, latency, whatever, right? To get the best experience, for those EAs really matters, right? Can I combine them? Can I portfolio manage that into it? Like, there's a million things that your right now platform has a restriction. You couldn't kind of do lots of those super sophisticated things around those things, right? But you could see with AI how you can very quickly go from, oh, I can do one at a time to 10, do a portfolio thing wrapped around it to manage those 10 and more and more and more. And I think that when you get a conduit, and you're going to get clients who are going to do this stuff, right? As you want a conduit that is not the conduit that we have today. So you need different choices to accommodate those, those things. And I think that's where the evolution is going to be higher. So is that AI knows how to trade? Of course not. Nobody, like, they'll never be able to predict the market. But could they now take, like the problem with market leaders, right? Somebody gets a track record for 6 months, 5,000 people follow them, and then they start losing money. And, we all seen that movie, right? But if you could take, and this is already starting, if you could take 100 of those and then put them in a portfolio and then say, okay, as they decay, throw out the ones that decay and do that dynamically, all of a sudden you don't need to be a genius, right? And your portfolio is not a genius portfolio, but you go from a B-book loser, this is not going to be a B-book loser, And so I think that is where it's going to change. And I think that's where brokers going to have to react to that, to that, because it's going to change where people come from system-wise and what they prefer. It's going to change the percentage of winners and losers. all of those type of things. I think lots of things will change.
I think just an interesting commonality between both our answers. And I think one trend that you're going to see shift in AI is there's been too much discussion around what is AI going to do? Is there going to make an AI CEO? Am I going to be out of work? Should AI be used to make my business more efficient? How are we going to replace people internal to our organization with AI? Shift the focus of how am I offering a service to my customers that's now enabled by AI and making them more efficient by interfacing my product and offering? You took the perspective of equipping the traders and a client of a retail broker by being more AI capable. We're one level back of that, of providing the brokers the use to use AI to differentiate themselves. So we're taking an external looking perspective on this. How do we make those that are users of our system more capable through AI?
I think that's all we've got time for. I can see the red numbers flashing. Thank you so much to our wonderful panel, and thank you everybody for listening.
Thank you.